Good afternoon, everyone. I'm Pamela Hastings, and we welcome you so warmly to another Barometer Readings webcast. Joining me today, as always, is David Burrows, our Chief Investment Strategist and President here at Barometer Capital. And we have a very special guest joining us from our trading desk, one of our key analysts on our investment management team, James Callahan. So we're pleased to have James join us in conversation with David. As always, David will provide us with a brief macro overview. And of course, we'd be pleased to address your questions at the tail end of the conversation, so don't be shy. You can email us at phastings@barometercapital.ca with your questions, or feel free to hit us up on the Zoom link or via the chat or the Q&A section. So with that, I turn the conversation over to the one and only David Burrows. Good afternoon, David.
Hey, Pamela, how are you?
Wonderful. Great to see you guys and looking forward to this presentation.
Thanks. Well, thanks for joining us, Pamela, and thanks everybody for tuning in today. Lots to think about. As has been the case for many, many months, lots of news flow to deal with, lots of things for investors to worry about. But the market continues to march on. And as always, there are haves and have-nots. And our job is to try and find our way into some of the haves and try to avoid as best we can the have-nots and try and put the odds in our favor and put a portfolio together that is relevant given the current market environment. So as always, I want to start just from a top down, taking the lens back to a 30,000-foot view to say from a macro perspective, which asset classes do we want to focus in? Which ones maybe do we want to avoid? And then within those groups, which sectors and themes are benefiting from the current structural backdrop? Which ones are challenged? And what we can glean from the way the market is behaving as opposed to saying this is what we think should do well. So just starting out, as we always do, with a long-term picture of the S&P, we can see the long bull market from 1981 through 2000. The terrible secular bear market we went through from 2000 to 2013, where in fact the cash flow in the S&P quadrupled, but the S&P made no progress. I mean, certainly there were advances and declines, but you had to pick your spots. Now, what everybody's always afraid of is the type of declines like we saw 2001 through 2003 or 2008 through 2009. Those are ones that are tough to come back from and psychologically difficult to hold on through, but those aren't always the case. And for the most part, when we're in structural bull markets, we have bear markets that last 18-ish months. They go down 18 to kind of 25%. They tend to hold above a rising 200-week moving average. And as has been the case since this bear market began in January of 22, we have held the 200-week moving average. It continues to rise. And despite all of the fears, the market is slowly climbing a wall of worry. So the thing that makes it so difficult is that the market tries to shake you off its back. And if you read the newspaper every day, there's lots of things to be concerned about. And there certainly are parts of the market that we have to avoid. But I would say that since we made the low in October, it's now been almost 8 months, market slowly working its way higher. Now, it's not everything, but there certainly are areas to focus in. When we look at equities as a whole, globally, we think they look pretty attractive. But it is interesting that for the first time in many, many, many years, going back to 2009, the rest of the world is outperforming the US stock market. That's something to say because the US stock market has been a powerhouse and the one that we've all come to rely on. I think that's a structural change and we have to be aware of it. Doesn't mean that there's nothing to do in US markets. There's lots to do in US markets, but it also means we have to be open to having money in other markets geographically, as opposed to just focusing on what everybody knows, large cap US stocks. When global stocks start to outperform for over a year at a time, it tends to be then they outperform for many years. Doesn't mean it has to always be the case, but the reality is that that has been the way that it is. So we are very aware of that. And just to put a point on that, we've talked a little bit over the course of the last few months about having some money in the Japanese stock market. Certainly not a market that's overowned, certainly not one that's overpriced. It's rallied over the last 2 years, 3 years, but still trades only at 13 times earnings. And I had a very interesting conversation with a Japanese money manager over the past week who highlighted that the Nikkei exchange has gone to all companies that trade at below book value and said, using their moral suasion, we expect you to do something to try to unearth value in your companies if you would like to remain on the exchange. And as it is in Japan, when consensus ideas form, it's shameful not to follow on with the group to try to get things accomplished. So certainly we're seeing better performance. Lots of great companies. It used to be Japan was an export country. Lots of great companies selling things internally in the country. Lots of great robotics companies and industrial companies. And if you look at the very long-term picture of the Nikkei 225, again, something structurally has changed. This is the long run up into the peak in 1990-91. And we've been through 32 years of a long, terrible bear market for Japanese stocks. If you're living in the Japanese local market, you probably don't like the stock market very much. But we know when we exit big, broad basing patterns, it generally is the beginning of something. And we know it doesn't go straight up, but it means that the risk reward probably is in our favor. So it's something that we're keeping an eye on. So we think equities as an asset class are one that we want to be focused on. We want to maybe be a little bit more broadly based globally. We've talked about Europe as being an area we've got some more money in. Get some money in Mexico. We've got some money in the Korean market. Asia as a whole, from a breadth perspective, is looking attractive. And so I just highlight this Japanese opportunity. When we look at fixed income, we know that rates also move in very long cycles, and we've lived through a long cycle of declining interest rates, started in 1981 and bottomed probably in March of 2020, with the US Treasury bond yielding 60 basis points, 0.601%. The last time we saw a generational low in the US was in the late 1940s, after the Depression and the Second World War. The first bout of inflation kicked off a period of many interest rate increases, and rates moved their way higher till 1981. So this is a structural change. We have to recognize that. And while things may not happen all at once, it means we probably want to position for rising rates. And when we look at it this way, this is the 10-year yield. We bottomed in the COVID low in March of 2020. We broke all of the moving averages. We broke the trend. And now the yields have consolidated over the last 10 months or so, but they aren't moving lower. They've been moving higher. That makes it awfully tough to be a bond investor. If you own the TLT, it's been a long, rough ride since the early part of 2020. This is the ETF that owns US long treasuries. And once again, starting to weaken. Now, that could have something to do with the fact that if they do pass the new debt ceiling, that there's roughly $1 trillion of issuance that has to be made in the next year by way of treasury bills and treasury bonds. That's a lot of issuance. The market's going to have to absorb it. So even though there's a lot of money flowing into bonds, bond prices have not been going the right direction. We consider bonds to be in a bear market. And so other than very short-term bonds, we've been sort of avoiding bonds as an asset class, even though people think of it as being a very defensive asset. If we keep doing this comparison, stocks by way of the S&P relative to bonds by way of the TLH, a relative return chart, you can see that stocks have slowly been rising relative to bonds, meaning they're outperforming. So this is why we like equities, and we really don't like bonds, even though I know it would sound a lot safer to say to people, let's put a bunch of money in bonds and wait for all of this to pass. So far, the market is telling us something different. When we look at the commodity asset class, a long bear market resolved in 2020 to the upside. And certainly during this rate hike cycle, prices have moderated, but they certainly haven't broken down. They've consolidated. And at some point, my guess is we're going to see them resolve higher into the next leg higher in a new secular bull market. Because when commodity outperformance starts, it tends to go on for a long time. We know that similar to what happened in 2001, gold started to outperform the S&P and then outperformed for 10 years. Gold started to outperform the S&P in 2022. Even though we're only 3 or 4 months beyond that point, we're just consolidating. My guess is likely it resumes as gold slowly comes out of this very big cup and handle. Now that makes some sense because governments have shown a willingness at any sign of concern to start the printing presses once again. And here we go with looks like a debt ceiling deal, and looks like there's going to be more issuance of treasury bonds and more printing of money. So we like to make our decisions based on our process. We aren't going to be everywhere all the time. We believe very high percent of return comes from getting to the asset classes that have a tailwind, and then identify the sectors and themes within those asset classes that are benefiting from the current structural backdrop. So 80% of return is getting to the right neighborhood. We use our top-down process to try to identify those groups that are beneficiaries of inflows of funds. And then we use our bottom-up security selection to try to find securities within those groups that are good getting better, where we can see based on the numbers, there is something changing in the income statement and the balance sheet that can cause acceleration in the underlying business model and can cause revaluation in the shares or multiples to expand. And sometimes it's hard because great businesses tend to get better. We're in a world where the big are getting bigger, and they tend to get more expensive when that happens. So we're going to talk about that a little bit today. But we're using our top-down model to identify the neighborhoods we want to focus in. We use the bottom-up security selection to find securities that are outperforming their peers, both fundamentally and technically. And that's where our portfolio lives. Then we use our stop losses and our selling strategy to carve out the positions that don't work. Sometimes, even when we don't want to be sellers, we think fundamentally the story is really, really good, or we think that the management is great, or we think that the sector or theme is one we want to be focused in. But if companies aren't performing the way they should be, given what we think we know, our job is to go to the sidelines and use our stop losses. From a top-down perspective, we want to focus in areas where it's showing expanding breadth. And I do these webcasts each week to discuss what we're seeing from these breadth trends so that people can understand whether or not we're following our process. Similarly, when breadth starts to contract, we want to reduce our holdings in favor of groups that have expanding breadth. So we are tactical in our decision-making. When things get sloppy, we raise some cash and tighten up our stops. So last week, we highlighted, like over the last several weeks, breadth, or the percentage of stocks in uptrends in Canada and in the US, have in general been weak, meaning that fewer and fewer stocks have been performing well. That is a cause for concern. I said last week, we haven't been adding a lot of new positions, which we don't do when we see deteriorating breadth. Doesn't mean we're going to run out and sell all of our positions. We're always going to focus in strength, but we want to be really, really tough on positions that don't work. Globally, breadth has been expanding, which helps explain why we're seeing better performance outside the US. Our short-term indicators were mixed. And as we sit today, it's the same picture. Things have generally been about the same over the last week, although the percentage stocks above the 50-day moving average showed some weakness. So here's the S&P. This was the high in December of 2021. The bear market we went through, the low that we saw in October, now many months ago, we've seen a series of higher lows and higher highs. And here we sit as of today at the highest level we've been at going back to last September. Doesn't mean everything's doing well. And that is something we reflect in those breadth models. If we compare the equally weighted S&P 500, where we give every one of the companies in the S&P an equal weighting, and compare that to the market cap weighted S&P, which means you take the biggest companies and they get a much bigger weight than the smaller ones. It means that Apple and Amazon and Nvidia have a much bigger impact on the index. We can see that the equally weighted index recently has been significantly underperforming the market cap weighted, which means the strength in the very biggest companies has been overwhelming the weakness in the smaller companies. So when we look at Brent as of today, as I mentioned, the percent of stocks trading above the 50-day weakened a little bit this week. Percent of stocks trading with weekly price momentum also weakened. Globally, things still look quite rosy. And for some areas of the US market, there's some great strength, but we have to pick our spots. The spread between the S&P 500 market cap weighted and equal weight is as offside as it has been in many years. This actually has been extended since the end of April, so that we actually have the biggest outperformance by the market cap weighted S&P going back to the year 2000. It's a big difference. So let's just talk a little bit about those leadership themes. As of last week, we mentioned a couple of things that were positives. First of all, the group that has been a real pain in the markets behind, the banks and the regional banks, both have shown some improvement in Brent. Savings and loans, that's regional banks, and large banks, both turned to capital letters, which means the percent of stocks in uptrends started to expand. When we look this week, there's been some further improvement. Brent's further improved for banks and further improved for regional banks. But in particular, over the last week, the greatest improvement was in some of the technology groups, semiconductors, computers, software, electronics. These are groups that have a big impact on the S&P. The percent of stocks in uptrends is down about 1.5% over the course of the week, meaning fewer net new buys than net new sells. So let's talk about the biggest impact. This is the large cap tech ETF, XLK. You can see dominated by the largest companies. Microsoft is 23% of the S&P, Apple 23%, Nvidia 5%, Broadcom, Cisco, you can see down the list. Now, within this group, we own several positions. And I've talked about the fact our job is to recognize change. We came into this year, we had a 0% weight in tech and had since February of 2022. And we had a pretty dim view of the group. And frankly, when relative strength started to rally, I almost apologized for having added positions, but we felt they were important to be willing to be open-minded, to put on some positions, because it's possible something changes. And you can see that relative strength versus the S&P has continued to improve. And over that period of time, our weightings in these stocks has continued to improve. Now, I've asked James Callahan to come on the call today. James is one of our analysts who's focused on US equities. In particular, he works with Jim Skatakis, who leads our US equities group. But James' job is in particular to identify companies that make sense given the current market environment. And he's raised a bunch of these as ideas. And I have to give him kudos because they are making a difference. So James, welcome on the call today.
Thank you, David. It's great to be here.
Now, you look like you're in the witness protection program because there's a lot of light behind you and you can't see your face.
Oh, no, I'm sorry.
That's okay. Move a little closer. See what a good looking guy you are.
Is that better?
I put on the screen here a chart that is just, incredible. It shows that Meta, Amazon, Apple, Microsoft, Google, Tesla, and Nvidia are up together 44% on the year as of last week. If you look at the 493 remaining companies in the S&P, they're up 1%. That's incredible. And Diana mentioned today, she was on BNN and mentioned that about half of the companies in the S&P are down on the year. the S&P 500 is up on the year nicely, but really dominated by these companies. Talk to me a little bit about, and maybe you can talk to the group a little bit about what gave you such conviction after such a difficult year to recognize something was shifting.
Yeah, absolutely. I mean, it's been, I guess, to highlight two themes. One would be strength in the semiconductor names. So that really comes through in the move in NVIDIA. And I guess on the other side, we've seen in the mega cap tech US space, a focus on cost cutting for the first time really ever. So both of those really gave us the nudge to take a closer look at these names and to see, like you mentioned earlier, some good companies getting better.
Right. Now, you can't turn on the TV right now without a discussion about AI. And I remember the day that I came across ChatGPT, and it feels like that was a long time ago, but it really wasn't. And we jumped right on and got familiar and recognized that this was really a game changer, and it might have a huge impact on a lot of businesses, but some immediately. And you were quick to identify the fact that it could have a huge impact on the semis. This is the chart of the SOXX, which is the semiconductor ETF, and it's broadly based. You can actually see that NVIDIA is 8.8% of this ETF, but what a move it's had since October. It really bottomed before the rest of the tech group did. Most of tech bottomed in December. And, we can see what's happened here over the last few weeks. So the obvious one that stands out is NVIDIA. Talk to us a little bit about why you have so much conviction in NVIDIA, because we had a bit of an argument when you brought the idea up, I will admit.
That's right. Yeah. I mean, so I guess to set it up, it's a name that we followed for a long time. We love a lot of things about the company. The management is fantastic. They have a competitive edge in technology, but at the end of the day, their business is cyclical. And so what we saw at the end of last year, really midway through last year, we saw evidence when they reported their third quarter of 2022 numbers that a lot of their business lines were troughing. So around that time, we saw data center sales come down a little bit. A lot of the hyperscale providers were focused on cutting cost, or were beginning to be. So we saw some order deceleration on the data center side. And on the gaming side for NVIDIA, we saw severe weakness based on what had been an undersupply situation with a ton of demand driven by stimulus payments in the US and Canada. The consumer was cashed up. A lot of people were buying gaming GPUs for their PCs. And we saw a classic supply glut where supply came online and demand fell off. And so we had a ton of gaming GPUs, left as orphans. We saw at the beginning of the year last year, just as an anecdotal example, it was almost impossible to get a brand new NVIDIA GPU for gaming. So
James, to risk being pedantic for some people, there's some people who be quite familiar with NVIDIA and what they make. Some others that may be a little baffled. The term GPU, graphics processing unit. Talk a little bit about that and what it is that they are so good at, and what their units are so good at, and what they're generally used for.
Sure. So NVIDIA was really the first graphic processing unit company. Not to restate the name, but a GPU goes into a computer so that it can more quickly and efficiently process graphics. So when you're building a high-end PC that you'd use for gaming, you need to be able to process high-quality graphics really quickly. So you add a GPU into your unit to be better able to do that. What was discovered around 2016 and 2017 was that in a data center, when you added GPUs into a server stack, you were able to process calculations much more quickly. And the reason for that is actually the same reason why GPUs are used in AI development. It's because a CPU, central processing unit, can do calculations one after the other, but a GPU can actually do multiple calculations at the same time. So it acts as a complement to a CPU inside of a data center. And for AI development, you need to be able to do multiple calculations at the same time to train the models. That's why GPUs are used.
Right. So the end markets that they were selling into, gaming in particular, and then, we all remember when, all the GPUs going to be bought by crypto miners, and then going into data centers, those are huge growth markets for them, and went through some natural troughing last year. What was it that caused you to recognize that this would be a centerpiece for AI?
So it actually coincided. So the release of their third quarter 22 numbers happened late October, early November of 22, which is right around the same time that ChatGPT got released to the public. And so we kind of looked at both of those pieces of information. Just to speak to the earnings report specifically, they took guidance almost into the ground. So they really took tough medicine, took guidance almost into the ground. Market actually, treated the stock pretty well after that day, because as you know, the market's forward looking. Once we saw evidence of troughing, then things started to get better. Investors were willing to look across the valley. So NVIDIA took guidance down so sharply that it was tough for the situation to get worse for them. That coincided with the public release of ChatGPT. And so for both of those items, I think it speaks to our process. We looked at both of those and thought, in addition to completion or near completion of a bottoming process from a chart perspective, the fundamentals were poised to get substantially better. So we took another look and we took a position early in the year.
So not to quiz you, but what it would, just for people's benefit, what is it about that change makes it attractive based on the way we look at the world?
I think it's just evidence of a good company getting better. It's a name we followed for a long time, and I think it's tough to find a company that can go through multiple acts. So a lot of the mega cap tech companies have the acts for NVIDIA that they've gone through, and consider also that they're founder led, which is uncommon. The first act would be gaming. They're top tier in the industry for gaming. Nobody can compete. The second act would be the ability for them to sell into data centers. And very quickly, the data center segment overtook the gaming segment in terms of revenue, which was surprising. It was huge, explosive growth. And when you see something like AI come across the bow, there's potential for it to be a third act for this company, which is why the stock's reacted the way that it has so far this year. Right. Because market's now seen NVIDIA successfully execute through two acts, grow explosively, with a third act potentially on the horizon. It's compelling.
So we often say that when companies start to go through change, sometimes the change happens much faster than even we expected. When they reported their earnings last week and gave commentary, what stood out to you?
Yeah, there was one number that stood out to everyone. It was second quarter revenue guidance. So expectations, sell side analysts, the compilation of their expectations had been for NVIDIA to guide to $7 billion in revenue for the second quarter. And NVIDIA came out and guided to over $11 billion in revenue, which is a beat in guidance that you never see. You never see a beat of that magnitude. It really is explosive, and I think it shows two things. It shows huge demand by the hyperscalers, so the data center providers, Microsoft specifically, that are using these GPUs to train AI large language models. So the demand is huge, but it also shows a better supply situation, which I don't think is as widely talked about. I think that NVIDIA is taking some production capacity in TSMC, Taiwan Semiconductor, where these chips are made, from other semiconductor companies that may not have explosive demand.
Right.
And Taiwan Semi is very happy to give them that production capacity to service products like this.
Right. So the only thing I would say about this is when something like this happens, a step change, the market generally is always behind. And you had a move like we had last week, which is extraordinary. Stock went from $300 to $400, a 25% move in a $300 stock. Many would say, well, it's 37 times revenue and over 100 times earnings. How can we possibly pay that much? But in some ways, It's almost less expensive today than it was when they reported earnings because they upped their guidance so much. So it's extraordinary. Now that it didn't just impact NVIDIA, certainly the chase for AI is impacting Microsoft from a software perspective. They've got their investment in OpenAI. And how do we think that impacts Microsoft?
I mean, it's huge. So one way is, I mean, they get some revenue out of OpenAI, which is great. They've locked down exclusivity on that technology, which right now seems to be best in class from an AI perspective. But the other piece that really helps Microsoft is they lock down exclusivity for all of the workload that OpenAI is doing to happen inside of Microsoft's cloud. So Microsoft's cloud segment is probably the most closely watched segment in terms of growth, and they've secured exclusivity on what could be a huge customer through this deal. I mean, it opens up opportunities for them to come and compete with Google in search. Already, you know, Bing is a product that I don't think anybody's used in a long time, but already GPT-4 technology has been integrated into Bing. So, you know, there's potential there. Every incremental percentage point that in search that Microsoft could take away from Google benefits Microsoft. You know, we've not seen that come through just yet. And you know, maybe we can talk later about Google's competitive response to that, which is pretty compelling.
Well, why don't you do that? Why don't you do that now? I mean,
yeah, absolutely. So, I mean, the chatter for the last few months has been that Microsoft would be able to come in and do this to Google, take some search market share from them, and just, I mean, Google had been considered to be the AI leader. This is something that they've been spending on for decades now, really internally to develop AI systems. And when OpenAI came with a public platform that everybody could get on and use, it seemed like they were eating Google's lunch for a while. But what we've seen now is a competitive response from Google. So they've come out and they've released Google Bard, which is a direct ChatGPT competitor for use by the public. It's actually not available in Canada, the new version that they've released, but hopefully soon. And that product specifically is really compelling. The difference is that Google Bard now can access the internet, so it can get current data where ChatGPT can't yet. And it can access things like flight data, so you can ask it to book you the most efficient route to a destination that you'd want. It actually has access to some of their proprietary data. It has access to all the YouTube transcript data, which is interesting. And so they have a compelling release schedule. We'll see more products come out of Google over the course of the year.
So, you know, just to make a point, so NVIDIA is the single largest position in Barometer. In the top 10, Microsoft, I think, is number 2. Google is in the top 5. Meta is number 6. And they didn't start this way, but this is what we do. We start with a position and we add. And as it stands, you know, I think that we're sitting at about 21% in technology sector. And I certainly wouldn't have guessed that we would be here at the beginning of the year after the bear market we saw last year. But one thing we've learned is you don't fight the tape. And certainly, you know, these are benefiting us. And we'd like to own more, but frankly, I think Apple and Microsoft are 15% of the S&P. I'm not sure we can have 15% of our portfolios in 2 names. You know, so we have to deal with concentration, like one of the things to do. James, thanks so much for joining us today.
Thank you, Dave.
We'll have you on again shortly. So just to speak to the concentration that we're seeing in where the returns are coming from this year, this is a point and figure chart of the bullish percent for the NASDAQ, or the percent of stocks in uptrends. And actually, despite the fact the NASDAQ has been so strong, since February, the percent of stocks in uptrends has been deteriorating, meaning it's a narrower and narrower market. Only 30% of stocks are in uptrends in the NASDAQ. And it's perplexing because you can't just focus in a few names. You need diversification in the portfolio. It also means we're not adding tons of new names, but we're certainly watching for groups that are launching. Outside of technology, you know, we continue to have a good size weight in energy, and it's a little bit frustrating. This is CNQ, you know, back to 2007. It's been a huge consolidation, and the rally started in 2020. And over the last few months, we've been consolidating. This is a wildly bullish formation when a stock goes sideways for a long period of time, then comes out of that price pattern, it generally means it's the beginning of a new bull market. But certainly, you know, the Fed's tightening and things like concerns around the debt ceiling, things like some of the geopolitical risks have held things back. My guess is there's a whole lot more upside than downside here. So we're waiting for it to complete its price pattern. We own MEG Energy also, in situ oil sands, same kind of consolidation. My guess is over the next little while, we'll see that sort of some continuation, but certainly these are all trading above the long-term moving averages. In basic materials, we continue to like companies like Teck Resources. Again, frustrating. These are monthly bars. We pulled back over the last month as we were coming into the debt ceiling. We talked about the fact we're likely to see some choppiness in markets as we come into the debt ceiling. But my guess is likely this political year will resolve over the next week or so, and we'll see whether the Fed is in fact maybe done tightening with rates where they are. Industrials over the course of the last couple of months have been consolidating higher. Some groups inside industrials that have been really quite interesting. Anything around green energy transition and reshoring of manufacturing. We looked a couple of weeks ago at mid-sized industrial companies and some of the automation companies. We talked about ATS, which just continues to rally relative to the S&P and relative to the TSX. Within industrials also, we have GFL Environmental, which has been a real juggernaut in waste management. And even Air Canada, you know, is trading better than 80% of the companies in the S&P over the last 52 weeks, and lots of demand for travel there. So between the defense stocks, some of the machinery companies, some of the transports, there are some things to do in industrials. We think it's generally an under-owned group. If you were going to fade the economy, concern around recession, this is a group you would fade, but they've been remarkably resilient, which tells me something. Now, financials have been a concern. We know that the banks and the regional banks had a very sizable decline in February and March. They've sort of been stabilizing. This is the overall financial sector, which also includes insurance and then some of the fintech companies. But within the group, JP Morgan has been our biggest holding. It's number 3 holding in the firm. Royal Bank would be the other big one. It's been a significant outperformer versus the XLF. Pretty consistently outperforming going back, you know, to October of 2022, and one that we think benefits from these things. Now, you know, there are sectors that have risk due to AI, and certainly some financial services do. If you want to avoid some of that risk, some of the very large players, JP Morgan in particular, is a massive spender on technology. They were a big beneficiary of deposits as money came out of the regional banks, and they've been a big beneficiary in capital markets as the market's been going through its process. Fairfax, in the insurance group, we have a couple of big insurance companies. Fairfax would be one. We're trading just about 52-week highs. Industrial Alliance, IAG, also trading better than 84% of companies in the S&P. So the insurance, specifically property and casualty, you know, continue to act well. So large banks, property and casualty financials, think they're quite interesting, certainly from a dividend growth perspective, which is a theme that we want to continue to focus on for our income investors. And then with the consumer, we've had a fairly narrow focus. If there's a group that is at risk due to higher rates, it's consumers. Unless we're focused on the seniors community, where the T-bill yields are certainly higher, they're making a little more income on their money market funds. But the home construction group has been remarkably resilient, and we've seen a series of higher lows and continues to act well. We do have weightings here, even though you might be concerned if there was recession, but the market seems to be shrugging that off, and they're inexpensive companies. Now, groups that we've been avoiding, we're still avoiding. You would expect that defensive sectors or groups that are not economically sensitive would be the beneficiary of a lot of investor flows, and they have. But the prices are not following along. And so we watch for change here, but look at the relative strength for utilities since December of 22. Continue to weaken relative strength, new lows in this XLU, which is the utilities ETF. Telecom is the same. Consumer staples is the same. All the most defensive sectors, least economically sensitive. But frankly, they all trade a lot like the bond market, right? Long-term dividend payers with not much growth and high yields. And we know that bonds aren't acting well. So bonds and bond proxies, things that act like bonds, just aren't acting well, and things that we've sort of continued to avoid. And that includes REITs, real estate investment trusts, new relative strength lows. So we really got to pick our spots. We've got the AI-related large cap tech that would be disastrous if we didn't own right now. Thankfully, process pushed us into these companies. We've got companies that can't be replaced by AI and will be big beneficiaries of green energy and electric vehicles, like the copper producers and so on, although we did have to take our weight down. You can't replace energy with AI. And then we're really avoiding the bond proxies. And even though they seem safe, they aren't acting like they're safe, whether it's bonds or utilities or staples or REITs or healthcare for that matter. Not to say there aren't things to do. We do have Eli Lilly, which has been acting very well, and Merck. But in general, the healthcare sector has been sloppy. So what does that all mean? It's interesting when we look at investor behavior. This is the May of 23 positioning chart that shows money poured into bonds. It poured into consumer staples. It poured into cash. It poured into utilities, and it poured into healthcare. And with all of that, prices couldn't go higher, they went lower. On the other hand, money pulled out of some other big groups. When we look at what is most expensive in the market, well, consumer staples, utilities, consumer discretionary, these are the defensive groups. So you're paying a high multiple, they're very crowded, they aren't acting very well, at risk of people capitulating. And at the other end of the spectrum, you've got groups that are not well loved, that are much less expensive, that can't be replaced by AI, and have good supply-demand metrics. Now, we're going to get an OPEC decision over the next short period of time. They're talking about cutting production again. We'll see whether that impacts energy prices and whether they come out of this consolidation they've been in. But I would say that the market overall is not terribly expensive. But we do know that bonds are the most crowded they've been since March of 2009, which was the bottom of the financial crisis. So you can tell people have been afraid. But frankly, the risk part of the market is acting reasonably well. So from a positioning standpoint, for financials, we've been roughly about 16% over the last 2-3 months, which is a little above market weight. We are more focused on insurance and very large banks, virtually no regional bank exposure, but certainly less than we were a month ago. Now, I think I haven't put the new chart in here because I know that technology as of today is 21%. And from a materials standpoint, materials was 8% last week. It's 4% today. I know we reduced a couple of materials positions in favor of adding some more tech weight. But in general, the real estate, utilities, consumer staples, communication services, and consumer discretionary has been a considerable underweight. Our bond weighting has been about 5%. That's relatively short-term bonds. And we've got about a 5% cash weight portfolios. Sorry, that's corporate bonds, government bonds, about 8%, again, short-term by nature. So a little bit of cash, good exposure to the tech sector, about 21%, good exposure to industrials, some good exposure to energy, and underweight the defensive groups. So tricky market, number of stocks beating the S&P index. It's the narrowest market we've seen since 2000. From a risk perspective, VIX is not showing us that there's a major problem. It is not elevated in any way. We know that big money exposure and bull bear sentiment is extremely bearish. And we know there's lots of cash. We've talked about that over the last few weeks. There's more today than there was then. We know that there's some significant equity shorts in E-minis, and that was a lot of it put on coming into the debt ceiling impasse. And we know that long short hedge funds continue to have very short books. So credit risk, it's not elevated. This is elevated credit risk. This is where investors demand excess return to buy a corporate bond versus a treasury. And we are not anywhere near extreme levels. So our belief is that we continue to go through a bottoming process, and we continue to climb a wall of worry. And there is not going to be a bell that goes off to say all clear. Over the next week or so, I know there's going to be lots of wrangling over getting legislation passed on the debt ceiling. There's going to be lots of machinations over the next few weeks as to whether the Fed is done or it's going to pause. We're all going to watch the inflation data. But I would say that the sector work points to a more constructive market. And if things get worse or the breadth contracts, we will raise a little more cash and be a little more defensive. But the choice right now is not to be in bonds. The choice right now is to have some economically sensitive exposure to commodities. The choice right now is to have some industrial exposure. It looks as though reshoring is a real thing. Some exposure to green energy and electric vehicles, and some exposure to AI. And we'll continue to look every week at what's changing. But here's where we sit today. So with that, Pamela, maybe I can answer some questions.
Thanks so much, David. Great overview. And James, it was a pleasure to have you on this evening's program. So we have a question in here from one of our favorite viewers, Stephen in Toronto. And Stephen asks, David, I presume our well-positioned tech holdings have been very helpful in our income and balanced pool positions. What themes are holding back performance in those two funds?
Both great questions. Okay, so let me just start here. See if I can share a couple things. First of all, just to make a point, because I didn't put the rate slide up earlier. So tech as it is 20.5%. So you can see that came up about 5% in the last week. Actually, a lot of that was from performance. But we did top up a couple of positions. You can see financials about the same, industrials about the same, energy about the same. You can see the materials is about half. So materials would be about half of the impact over the last few weeks. There certainly have been hedge funds making a bet that if the economy is going to slow down, you want to reduce holdings there. The point I made earlier was that given the consolidation that we saw in commodities, the pullback relative to the rally off the lows in 2020 has been very, very small. Remember that in 2022, commodities were up over 20%, and that was against a bear market in every other asset. Energy was sharply higher. So they're going to have a rest, and they have had a rest, but they're not down substantially. They certainly are negative over the course of the last few months, but from a trend perspective, they're okay. So I would say energy and materials probably have been a negative. I guess the one stock that we don't own, or two stocks we don't own that probably I wish we did own, Tesla and Amazon in the consumer sector. That's probably a miss. So, I think that's been a mistake. Both of them have had great start to the year in the NASDAQ 100, and probably we could have some weighting there. I think if you were to go through the course of the year to this point, there has been some choppiness that has caused us to get stopped out of some positions. Usually when you're going through the machinations of a bottoming process, you get stuck rally and then loses grip and pulls back. We get stopped out of positions. Eventually, when things start to trend, we get positioned and stay positioned. So, the technology position has built over a period of months and is additive. And if that's in gear and stays in gear, then likely we benefit from that for a while. But there's been lots of choppiness, and I think the stop losses have probably cost us a bit of money so far this year. Those would be the key things.
Thanks so much, David. We have another question here, and this question is as follows. What has to happen, David, for fundamentals to matter with oil pricing?
That's a great question. Well, I think one of the big issues is that that individual investors and a lot of institutional investors are just not engaged right now. We know that exposures are very, very low, and we know that that there's a lot of money sitting on the sidelines. A lot of the trading day to day right now is algo trading or automated trading machines, and sort of high velocity hedge funds. So in the absence of big money, and the big money is big institutional pension investors who buy and then they sit on positions. In the absence of big money being in the market, the little racing cars running around trying to scalp nickels and dimes have a big impact. And if you're trying to make a bet that the Fed's going to slow the economy down, energy would be an obvious one to bet against. Historically, materials would be an obvious one to bet against historically. What has to happen, I think, is to start seeing big money get re-engaged. And pretty quickly, I think that some of those speculative bets will get washed over pretty quickly. I think Biden has signaled that they're going to start rebuying to restart restocking the strategic reserve. That's going to take a long time. OPEC has signaled that people shouldn't trifle with them because they do plan to cut output. They're not happy with where oil is trading currently, and they can have a big impact. So there's a few things that can happen. But the thing is, you generally can't wait till bad news resolves to get positioned because things can happen awfully quickly. We know there's great value in the companies that we own. And we know that while they pulled back, they certainly aren't technically broken. So it's okay to be patient because we can't have everything in high multiple growth stocks.
Thanks so much, Dave. The final question for this evening comes from Lawrence. He wants to know, and this question is actually for James, our NVIDIA expert. If James is still available to answer questions, James.
I'm here.
Everyone loved your presentation, by the way, so it's always nice to have you. Lots of questions on NVIDIA, specifically one question coming in on who makes NVIDIA's GPUs.
Yeah, so NVIDIA's GPUs are made with leading edge technology, and there are only two places that can do that. The first is Taiwan Semi in Taiwan, and then the other one is Samsung in South Korea. So they split production between those two places.
And James, Lawrence wants to also know, do you think NVIDIA could be short-term overbought here? What are your thoughts there?
I mean, it's possible it's had a good run, but an overbought condition is never a reason to sell a stock. Things can remain overbought for, weeks, months. So no, we have a disciplined selling process that we follow, and NVIDIA still looks great.
Thanks so much, James, for joining the program this evening.
Thank
David,
you.
I'll leave you with the final word.
Look, I want to thank everybody for tuning in. We try to share changes in our thoughts as they happen. And I think if you've been tuning in regularly, you've heard sort of an increased exposure to tech over the course of the last few months, and a recognition that it's just behaving well. We got to be there. I was sure happy to have the exposure we had last week. because that definitely had a positive impact. You know, we're sitting here now at the end of May, and things will be a little quieter, I'm sure, through the summer. But there's a lot of catalysts out there. We start to see a little bit of weakness in employment. That would probably be a good thing. If we can see inflation back off a little bit more, that would be a good thing. See the US dollar back off a little bit, which it did today. That would be a good thing. Certainly, the rally in the dollar leading up to the debt ceiling impasse had an impact on energy and materials, and I'd love to see some of that pressure come off. So we'll update again next week, and hopefully people can join us on Tuesday. And you know, tell your friends if you enjoy it. We're happy to have you on. So thanks very much. And if you got questions you're afraid to ask on the webcast, don't hesitate to send us an email or give us a call if you'd like to have a conversation or you got further questions. You know, let us know, and we're happy to jump on and speak with you. That's what we do. Thanks very much. Thanks, Pamela.
Thanks, Dave. Thanks, James. Bye-bye.